year, and the S&P is up a little bit over 3%. So is this the best we're going to get this year? Because we can still sell in May and go away. We got one more day.
You know, our position right now is we think you should be cautious. We think you should play defense, not here, not offense. And the reason is, I think you want to focus on protecting capital. You want to invest with a margin of safety. The outlook right now to us is a little gray in the sense that you have an aging market cycle, an aging economic cycle. Corporate profits are at their peak. Complacency sort of low. And you think you have risks hiding in plain sight with respect to the Chinese banking system problems and emerging market debt.
Well, one stock you like over at Highmark is GE. They're down around 3% so far this year, really underperforming the S&P. They're trying to make that transition to becoming a purely industrial company. They're more than halfway through it. So what's wrong with the stock?
GE is a great example of what we do at Highmark. We take a very patient, contrarian, long-term approach. And GE is going through a silent transformation right now. We think is underappreciated by the market. They've sold close to $200 billion in assets, becoming a pure-play industrial. By 2018, they'll be 90% industrial. They're launching productivity improvements. They're getting religion on asset utilization and driving improving margins. And we anticipate accelerated capital returns. So we think it's a great total return story at a reasonable, modest multiple.
You're also a fan of Target. The stock's down around 5% year to date. Their second quarter guidance really sank the stock. So do you think that they're going to surprise maybe over the course of the summer? Is that why you like this one?
We like companies that are undervalued with low expectations. I think Target fits the bill. And yes, it's been a difficult retail environment. Apparel's been very difficult. But again, this is a company that's transformed itself. They had difficulty in credit cards, they unloaded it. They had difficulty in the Canadian operations, they got rid of it. They subsequently sold their pharmacy business to CVS. They're getting religion, they're getting right side, they're getting focused on apparel, babies, family, groceries, getting back to basics. And we think, given the low expectations embedded in the stock, investors are paying attention.
And then finally, you're a fan of Microsoft. They also surprised to the downside during their quarterly results. Stock's still up around 11% year to date, but they were flirting with $60 a share for just a little bit there. Now they're back down, hanging around 50. What's going to take them through that 60 mark?
Another great example of what we do at Highmark. Not so much obsessed about quarterly results. We're thinking about the long-term value creation potential. We think Microsoft has a wonderful opportunity in front of it. They're transitioning from old on-premise selling to the cloud, infrastructure as a service, platform as a service, software as a service. This is going to increase their total addressable market. They're going to gain wallet share, and this is a compounding machine I think investors don't want to leave behind.
All right, thanks a lot, Todd.
Thank you.